24 seconds away from the opening bow this morning. Good morning to you all. Equity futures positive by 0.4%. 3-day winning streak coming into Thursday. Let's see if we can make that 4. If you're bullish on this equity market in the last 24 hours, you probably got what you wanted. CPI softer than expected, throwing PPI as well. Jobless claims going in the right direction, lower. And the earnings so far, early days I know, but so far so good. Look out for tomorrow when the bank earnings kick off. Let's see opening bow, switch on the board and get to the bond market. Yields tracking lower over the last couple of days. We're down 5 basis points on a 10-year. 380.83. Check out the 2-year. What a ride it's been in the last week. A week ago today, we were talking about a monster upside surprise on the ADP report. We had a 2-year yield through 5.1% and now down to 464 on a 2-year and down 10 basis points on a session. With that move, the dollar is weaker. This euro stronger. The euro against the dollar 111.83. We're positive there by 0.5%. For that currency pair specifically, that is 6 consecutive days of euro strength against the dollar. Crude pretty stable, 75.72 and unchanged on the session. About 45 seconds into the session, we are positive here by 0.4%. On the Nasdaq up by 0.7. This rally continues. One stock to watch at the open is Disney. Shares moving higher after extending CEO Bob Iger's contract for another 2 years. The company saying this: the extension provides continuity of leadership during the company's ongoing transformation, allowing more time to execute a transition plan for CEO succession. Ed Ludlow joins us now from Sun Valley, where that announcement was made. Morning, Ed.
Yeah, good morning, Jonathan. Disney modestly higher, 0.4%. As you said, the emphasis on the extended period, which sees Bob Iger in place as CEO until December 31st, 2026. There's a lot that he has to fix, but it also allows for that transition. And going into Sun Valley, that was the story. Who will succeed Bob Iger? Will it be an internal candidate like Josh D'Amaro, the Parks chief, or Dana Walden, the TV chief? We learned a lot about where Iger's head's at during that interview with CNBC. All options appear to be on the table. He talked about working with Comcast to buy out the remaining of their stake in Hulu. When it comes to sports, there's a position of strength, but they're open to partnerships, and we could see divestments in some of the other linear TV properties. The way that Iger put it is that he felt he had a lot of work still to do, and there were a lot of things that in the last year Disney got wrong, and he was forthcoming about that, particularly around how they marketed and handled Disney Plus. He was quick to point out that they reached 100 million subscribers far quicker than any other streaming platform had been able to do so, but that some of the marketing around it and the pricing would need to be reviewed. It was interesting, John. I spoke to Steve Pagliuca, the co-owner of the Boston Celtics yesterday. He's known Bob Iger for 20 years or so. He's an NBA board of governor member, right? And he makes the point that Bob Iger is very strong on sports. He's willing to invest in sports. So just as one case study, I think there's a lot of enthusiasm about what Iger will do to strengthen ESPN in particular. But no surprises here. Everyone I speak to was not surprised by this news, and they largely cheer it. They think that Iger is the right man at 72 years old.
So, Ed, why are we still talking about a successor? It's pretty evident to me that he's it, isn't he?
Yeah, it's interesting. I mean, I heard from sources that this process of finding a successor has been ongoing, like it's been happening in the background. And again, as per the interview with CNBC, Iger really emphasized this. They felt they needed more time to make a smoother transition. You know, at age 72, he described having a passion for the job, but I think, you know, they learned the lesson from Chapek and that they just need more time to do it. How long he'll be there, will it go beyond 2026? Who knows?
If you can lead the country at 80, I'm sure he can run Walt Disney Company at 72. Ed Ludlow, thank you, sir. Let's get to Meta. Shares of Meta, the FT reporting that the company is poised to release a commercial version of its AI model, helping the tech giant compete with the likes of Microsoft and Google. The stock is up by 1.65%. Abby has more. Abby.
Hey, John. Well, yeah, shares are really popping up for a 4th day in a row. In fact, over the last 4 days, up about 8%, the best 4 days since early May. And now this possibility of commercialization of their AI to compete compete with, as you mentioned, Microsoft and Alphabet, really a piece of the story. Now, they are planning on releasing that version of their artificial intelligence model that would basically allow startups and businesses to build custom software on top of the technology, very similar to Microsoft and Google, who really dominate, or Alphabet, I should say, who really dominate this space. But one thing that's interesting, John, this is just one piece of the puzzle. You know, some years are hot for companies, some years not. Last year, Meta down 64%, its worst year on record, as investors, not only did we have bearish market tone, but fretting about the metaverse and what it would mean, and that Mark Zuckerberg might just go unfettered in terms of spending. But now we have the year of efficiency, we have Threads, and now we have AI. This stock, John, on the year up more than 160%, heading to its best year ever.
Unreal, up about 1.6% right now for the year-to-date number, as Abby just said, just moved the decimal point over just a few figures. Shares of Meta getting a boost from Cowen right now, upgrading the stock to outperform, writing this. We think there's a room for further upside for 4 reasons. Consensus estimates are likely too low. The potential monetization from Reels and other sources or surfaces. Monetization options for its new Threads app, and potential for further cost cuts as well. Stock likes it across the board here. Better news for this company over the last 6 months or so. We're up there by 1.95%. Now up by about 2%. Let's turn to earnings season. PepsiCo delivering another beat and a raise this quarter. The CEO writing, quote, "Our strong performance gives us confidence that our investments are working. We'll look to elevate our focus on productivity initiatives and sustainability to win in the marketplace and fortify our business for the long term." Katie Greifeld has more. Hey, Katie.
Hey, John. It was a beat and raise indeed, and results topped expectations nearly across the board, even though we heard from CFO Hugh Johnston that the average price across Pepsi's lineup rose by about 15% in the quarter. Evidently, though, that's not scaring consumers away, and that growth is actually expected to continue. If you look at Pepsi's forecast, organic revenue growth will likely grow by about 10% this year, and that EPS should increase by 12%. So that's the good news. The potential bad news is that the World Health Organization is expected to release a report later this week about potential health hazards around aspartame, of course, the artificial sweetener that's used in a lot of Pepsi's products and its rivals' products. So CFRA analysts say that that could be a risk for Pepsi and for others. But for right now, John, shares are up about 1.5%.
Katie, thank you. Pepsi doing better. Down to another one this morning. Let's turn to the airline. Shares of Delta hitting a 2-year high after topping earnings expectations and raising its full-year guidance. The CEO saying this: consumer demand for air travel remains robust. There's significant growth still ahead. George Ferguson of Bloomberg Intelligence joins us right now. George, the stock is up by another 2%. It's absolutely flying, forgive the pun, so far year to date. George, why do you think this can continue?
So, I mean, I think that, probably leisure demand is very strong, and that's what we saw during the quarter. Demand into Europe was really, really strong. And I think this absolutely continues into 3Q. Probably a good portion of it's really already baked in, right? They've already probably sold the tickets. Fuel prices have been dropping, and that's given the airlines a real tailwind, and that's helped driving some of this performance. To us, the big question is, once we get past 3Q, will business demand feather in 4Q and 1Q and support this level of profitability? Plus, I think, we've seen a real, again, strong bounce back in consumer demand for air travel. It's a bounce back from the pandemic, and I think this was the year that everybody had to get back to Europe after not going for 3 or 4 years. The question is, will this persist into next year, especially if the economy slows? So that's what we're thinking. But again, I think 3Q is probably in pretty good shape already.
George, I was in the same boat. I felt the same way. Can we discuss airfares? Yesterday, the CPI print told me that airfares are lower. Your experience when you look at these companies, what's happening with airfares?
So, when we look at yields, which are really synonymous to us with airfares, they were up like 17% into Europe. Again, Delta said they flew the biggest schedule into Europe ever during the quarter. So they really stepped on that market, I think, to get these great results. The issue is domestic, though, yields were flat. And indications were also that load factor is probably coming down a bit on that domestic business. So I think we've seen already some of the consumer perhaps waning a bit on domestic. Again, it bounced back earlier, so we're not seeing as much of that. I've got to travel somewhere in the U.S. demand. Now, fuel prices have fallen pretty significantly, so the airlines do have room to give back some of those gains on fuel to support demand. We expect that they will, right? But I think we don't see a consumer that's going to continue to be just ready to pay whatever the next higher price is for an airfare.
George Ferguson on the latest with Bloomberg Intelligence. Thank you, sir. Delta up by 1.4%. Sticking with discretionary spending, Alpine's Sarah Woods questioning how much longer the consumer can remain resilient.
You're seeing it in the activity because people, in fact, are traveling and doing a lot more than they were able to do for a couple of years. The question is, how long will that extend, and can they continue to raise prices? And I think that's what's going to be the biggest issue for the consumer going forward.
Joining us now this morning to discuss State Street's Laurie Heinel. Laurie, wonderful to hear from you. It's been a while. Let's not leave it so long next time. Let's talk about that consumer discretionary spending. Laurie, your opinion on that. How much longer can that hold up?
Well, as long as employment remains strong, then the consumer still has some legs. But they've really been changing their buying behavior. So it's really been more about moving from goods into services. And we've seen that across every measure of the economy, whether it's in terms of the companies that are reporting earnings themselves, or whether it's even in the CPI data, where we're still seeing elevated prints on services inflation, even while goods inflation is coming down.
Laurie, you still see upside for stocks. Can you tell us why?
Well, we do think that we're looking better in terms of a soft landing. In fact, we think that the odds of a soft landing continue to increase. And so that really buoys our view on companies being able to weather some of these pressures over the coming quarters and then getting to the other side of that. So we've actually focused our equity allocations into large cap U.S., into European equities, where we actually think that there is some momentum. You've actually seen earnings hold up better in Europe, for example, than in the U.S. But we are avoiding some parts of the market like Asia and small cap.
Let's focus on large cap US first. Tech getting all of the headlines year to date. For good reason, it's flying. Outperformance again on the screen on the NASDAQ by more than 1%. Laurie, do you think this can broaden out beyond those 7 names we discuss all the time?
Well, we think that it can, and again, we've got to get through this next quarter of earnings season. We've got to get through inflationary pressures, continue to subside, making sure that wage pressures remain under control. But we actually think that multiple expansion can support the market through the balance of the year. Eventually, though, we have to get to a little bit more earnings expansion, and that's going to be reliant on the ability to contain costs while enabling economic activity to remain positive and not having that kind of hard landing scenario that everybody's afraid of.
Laurie, given how much multiples have done the heavy lifting so far year today, why aren't we at that point right now?
Well, we think that, first of all, there is momentum. There's good sentiment. Certainly, the dollar weakness is actually helping to buoy U.S. equity prices because there will be more opportunities for export and things of that nature. We are actually pretty constructive on the Inflation Recovery Act because, Inflation Reduction Act, because there's going to be massive spending unleashed. So one of the things that you're going to have to do is pick your spots here, though. It's not going to be a universal rally, but finding those places that can benefit from the tailwinds.
One thing we've heard a lot of are good things about the economy in the last 24 hours. PPI, CPI softer, jobless claims this morning lower, jobs, headline jobs growth in America slowing, yeah, but still pretty robust. Earnings this morning pretty decent. Do you think those themes will be captured in things like loan loss reserves, credit quality from bank earnings tomorrow?
Well, certainly, if anything, we expect some of that to be unleashed because we haven't experienced the actual losses or the bankruptcies or any of the things. And we see that across the spectrum, whether that's in high yield or whether it's other parts of the market. So one of the areas that I think will be interesting to watch is how that is starting to unwind because there isn't as much pressure or concern about a massive recession.
Where are you on the banks at the moment, Laurie?
We're pretty much neutral on banks. We're just finding better opportunities in places like consumer discretionary, in places like materials and industrials based on some of the things I talked about before. So we just see other sectors that are showing more promise right now.
Cruise lines have been flying, Laurie, not just the airlines. It's across the board here. I'm trying to work out if we're just trading on yesterday's news, if that story's over and we're going to move on to something else.
Well, it is very much a subsector by subsector story. It's very much a stock by stock story. But let's focus on, again, the consumer and where they're spending their money and the fact that they still have good employment and they still have good wage gains. And as long as we can get inflation to come down a bit more and we can get that to be sustainably lower, then we think we're going to be in a good place for the Fed possibly to even be lowering rates towards the back end of this year or early next year, which will, again, help us get more confidence that we've weathered the storm.
That performance year to date in the cruise lines, Carnival up by 124%, Royal Caribbean up by more than 100%, Norwegian up 77%. Laurie Heino, thank you on the latest in the equity market. Still looking for upside surprise in stocks. More broadly, about 14 minutes into the session, up by 0.5% on the S&P, on the Nasdaq up by 0.9. Yields are moving lower on a 2-year this morning by 11 basis points, 464. The dollar's weaker. The euro to a new session high of 111.94. Up next, counting down to bank earnings.
We're going to identify the issues that banks are going to have to pay for deposits. We're going to see that more clearly in the actual numbers. I definitely think that this earnings season is going to be super critical.
That conversation up next.
We're going to identify the issues that banks are going to have to pay for deposits. We're going to see that more clearly in the actual numbers. We're going to see that the regional banks probably have to come to terms with loan loss reserves, especially around CRE, and we're going to see probably less credit origination in general. So I definitely think that this earnings season is going to be super critical.
Wall Street gearing up for bank earnings. The biggest US lenders reporting in less than 24 hours. JP Morgan, Wells Fargo, Citi kicking things off. The numbers coming after a turbulent first half filled with layoffs and a regional banking crisis as well. Sonali Basak has more. Hey, Sonali.
John, when you look at it, all of the troubles become very expensive for the biggest banks and the smallest banks in the world. We are looking at jumping interest expense for the biggest of banks, and then you've been hearing about it all day, that deposit pricing going up for a wide number of banks. Now, if you're Bank of America or if you're JP Morgan, that still is about a couple basis points here. You're lucky if you get more than one, actually, but that gets a lot higher when you look across the spectrum, with some others having savings accounts north of 4% when it comes to savings. So pressure when it comes to deposit pricing. There are other expenses to look for that could really start to impact the bottom line. Remember, there's uneven amounts of firing, layoffs that are happening at a lot of these big banks. Those come with severance costs as well. When I talk to bankers across the street as well, they're also facing higher costs tied to travel and technology expenses as well. So a lot of pressure here on the bottom line, and then a lot of questions about whether some of these banks also need to adjust top line expectations when it comes to net interest income, given that there's been such soft lending across the board when you look at different types of businesses.
Sonali, let's build on this a little bit more. So Citi downgraded JP Morgan to neutral, as I'm sure you know, earlier this week. They offered 3 points on the banking stocks going into earnings season. I'd like your top pick out of these three. Funding pressures impacting the net interest income outlook. That was 1. 2, regulatory reform pressuring longer-term return profiles. And 3, one I've heard a lot about, credit quality concerns ahead of an economic downturn. What's the one thing out of those three that you'll be focused on tomorrow morning?
I think the reason I'm going to be focused a lot on that credit quality is because everyone else is focusing on the other two so very much. We're going to watch credit quality not just among the biggest banks, but into the credit card companies, into the regional banks with auto and other types of businesses that have very clearly been pressured. The question then becomes, into this part of the cycle, how much are they pressured? One more very quick thing here, John. There's some news items here today ahead of next week's earnings with Morgan Stanley and Goldman Sachs. You have Goldman Sachs selling $1 billion worth of Marcus loans to a private credit manager. That matters for Goldman because it helps them pivot away from that consumer story just a little more at a time where we're thinking about credit quality very severely, and we've seen them been hurt by credit quality in the past.
Sonali, thank you. Looking ahead to tomorrow, Wells Fargo, Citi, JP Morgan. On to next week, Bank of America, Morgan Stanley. On the 19th, rounding things out with Goldman Sachs. Tomorrow morning, we'll break down those JP Morgan numbers with Sonali Basak on Bloomberg Surveillance. First thing tomorrow should be around 6 to 7 a.m. Eastern Time. The broader market looking pretty decent this morning. Early days, I know, but about 21 minutes into the session, equities are up once again for a fourth session on the S&P 500. We advanced by 0.55%. They're the gains you see on the S&P. Gains on the Nasdaq as well, helped out by this move in the bond market following economic data yesterday and again today this morning. Yields are lower by about 10 basis points on a 2-year. Your 2-year 464, call it 465. Last week as high as 5% plus off the back of pretty robust jobs data and a blowout ADP report, pushing yields a little bit lower this morning. Of course, PPI and yesterday's CPI. So basically, complete reversal from last week. So yields lower, dollar weaker. The euro right now 111.92. The euro positive by 0.5% and very close to new highs for 2023. That's the cross-asset price action. Let's get you some sector price action. Here's Abby.
Well, not surprisingly, John, based on that cross-asset action, especially yields, we have a risk-on tone for stocks, especially from a sector composition standpoint. All of the mega-cap tech sectors, well, those are the top sectors, each up about 1% or more. Communication services leading the way, helped out by Alphabet and Meta. Interestingly, on bottom, utilities and real estate. Now, it makes sense from the standpoint that it's risk-on, that these less risk-on sectors are on bottom, but those dividends should look more attractive with yields plunging over the last couple of days. But investors looking past that and piling into big tech. The NASDAQ 100 up for a fourth day in a row. As for the month so far, well, communication services has it. It's the best sector, again, helped out by both Alphabet and Meta. Folks seem to want in on these stocks. And I think one thought on Google, John, is the idea that it's a catch-up stock. It's only up 38% this year, but compared to Meta up 160%, some folks are looking for the laggard.
Abby, thank you. Your trading diary up next. 25 minutes into the session, 4-day winning streak, longest winning streak in about a month since the middle of June right now. Equities up by 0.6% on the S&P, on the Nasdaq up nicely, up by more than 1 full percentage point. With the yields lower, the data better, equities so far doing okay. That's the price action. Here's the trading diary. Coming up, President Biden speaks at 10:30 Eastern Time alongside the Finnish president. Fed Governor Waller speaking at 6:45 Eastern Time. Tomorrow, G20 finance ministers kicking off their 4-day meeting over in India. And it's the big one for us tomorrow morning. Bank earnings begin. JP Morgan, Citi, Wells Fargo ahead of more results next week from Bank of America, Morgan Stanley and Goldman Sachs. From New York, with equities higher by about 0.5% on the S&P. That does it for me. Good luck for the rest of the trading day. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
About that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, July 13th. Here are the top market stories that we're following for you at this hour. Everything but the dollar. Investors pile into stocks, bonds, and commodities as the dollar hits a 15-month low, and PPI hints at deflation and no earnings gloom yet. Delta PepsiCo raised guidance. European luxury watch companies see strong demand and pricing. Big banks now on deck. We're going to get the preview for you. Betsy Graysick, Morgan Stanley Global Head of Banks and Diversified Finance. And Exxon's $5 billion pipeline grab. The oil giant makes its biggest acquisition in 6 years to capture carbon, store it in the ground, reaping big subsidies from the IRA. We're going to speak to the man behind the deal, Dan Ammann, ExxonMobil president of Low Carbon Solutions. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. So it's this joke in our editorial meeting that the buck stops here, that's like something we always wind up talking about and referring to and we don't know what else to talk about, but this is actually kind of the question today.
Because we did it maybe too many times a while ago as our question of the day, kind of when does the buck stop? This was when the buck was ascending. Now it's descending, so where does the buck stop? I.e., how low does it go, I think is the critical question. Alex, I can hear Goldilocks knocking at the moment.
Yeah.
The bears have definitely been consigned. You brought up Delta. Those numbers are sensational. Ed Bastian's having a great time right now. It's going to be interesting to see what Kirby and all the others have to say. You look at Watches of Switzerland, as you say, demand remains strong. Yeah, it's more at the bottom end, but still demand remains strong. Interest rates have gone up. It all looks good. Goldilocks is here, alive and well.
Well, even looking at ConAgra, which had issues with its profit because inflation, their input costs were still high, they were still able to pass on their prices. They still had demand. All the CEOs seem to be talking about things are going to go bad or the consumer's going to pull back, but then they all report that their demand is strong. It is a little confusing at the end of the day.
The dollar is down because things are going well. It's not down because there's some sort of bad thing happening in the United States. Rates have gone up. And now we're potentially getting to the peak of that rate hiking cycle, and maybe we are on a glide path to a soft landing, a feathery landing. It'll be nice and easy. That seems to be the narrative. I think there are plenty of reasons why you would pour cold water on that idea, but that's what the market is pricing.
Yeah, exactly. And I guess what I was going to add to that was ... yes. So the dollar is down, but not because the economy is down until it is. And I guess finding that level out and finding what that looks like will be our next task.
Yep, look at claims today. There is no crisis in the labour market right now. Certainly that's what the data are painting right now. You look further out in terms of what's anticipated for payrolls, and people are talking about negative prints by year end. Anyway, we are going on. So let's widen the conversation out. Where does the buck stop? Kriti Gupta, Liz McCormick joining us now to discuss. Liz, where does the buck stop?
Well, you know, there definitely seems like a groundswell of people saying buck keeps going lower. You know, it's just looking at our FXFC page for the forecasts. Some folks have dollar yen down to like 128 as far as stronger yen by mid next year. So, I mean, the momentum seems to be there against a groundswell of currencies, even like a lot of people flowing into EM now. So I don't think there's a lot of reasons that people are saying fade this. I mean, it didn't work out, the bearish trade at the start of the year, but like you're saying, it's really kicking in now. And I don't think it's so much like good news is bad news, kind of, or you were saying this is good news, but people are saying looking into the second half of the year, not only maybe the Fed rates peaked, other central banks are going higher, but also that the U.S. economy, maybe the labor market doesn't crack totally, but that we start to slow and other economies are doing okay. So it's like the economy differential is going to kind of kick in as well.
Yeah, that was like Liz's really smart way of saying Goldilocks, I think, to your point, Guy. So Kriti, what I'm also interested in is how much of the move that we're seeing, and whether it's yields or equities or the dollar, that we're looking at short covering being pressured by a weaker dollar versus something more fundamental here.
Well, I think let's put fundamentals to the side for a second, because some of this is that short covering that you just pointed out. It's also positioning, as you're also talking about, specifically when it comes to hedge funds. And I love this chart, if we can pull it up, that basically says that hedge funds have already flipped those dollar shorts. If you look at speculative positioning, for example, they've been short for a while now. Hedge funds just now getting on board. So it almost feels like they're throwing their weight behind a trade that already was kind of poised to flip. That being said, going back to the fundamentals, I think it's important to keep in mind that we are still looking at this divergence in rate hikes between the U.S. relative to the BOE, the euro as well. I mean, just take a look at the cable rate today. It's massive. 131 on that rate is pretty impressive. I think the ripple effects are going to be crucial here, because as soon as you see the weakness continue in the dollar, which it feels like based on simply where the smart money is going, that is the direction of travel, the correlations, the inverse correlations between the dollar and commodities and the stock market is building really, really quickly. So you're going to start to see perhaps another leg of gains.
Can I just point out that Alex is going to Europe this weekend?
I know.
It's going to hurt. It's going to really hurt.
I liked it at 105. 105 was good.
Yeah. the fact that we're talking about 1 at 130 being accepted, I remember when we got to 2.
All fair.
130 doesn't feel that impressive. But Alex, the other kind of element to all of this is that everybody's basically signaling they don't think anything bad's going to happen. Because if you think something bad is going to happen in the second half of the year, the normal trade is to run to the dollar. That's the safe haven. And the fact that everybody is as relaxed as they are right now and are willing to sell the dollar tells me maybe they don't think the bad things are going to happen.
Yeah, and that brings in the whole, like, where are you on the dollar smile, Liz, which is sort of what you were talking about as well. And I'm wondering what it would take for the smile to turn, where then you run into the dollar more for safety, or you sell it because you're like, ooh, the U.S. is really bad. Like, is that coming down for us?
Yeah, I don't think so, because I was looking at, Anna Wong and the folks at Bloomberg Economics say, Fed goes one more and then holds for a while. So that's like a no cuts for a long time. But they, the BI folks are saying that's still good for the dollar, because this risk on we're seeing, like stocks higher, like you said, buy everything except the dollar, as long as you have that. So it's seeming like a lot of people are saying we're not going to unravel into a crisis, right? We got that flicker in March of the banking crisis and that went away. So we won't have that, dollar smile of, complete trouble that Stephen Jen always talks about. Then people buy the dollar. By the way, he's saying cuts are coming next year and he's bearish on the dollar. So there just seems to be everyone piling on. But yeah, I mean, I think risk on and stability and stocks doing okay is going to keeping the dollar downside momentum going.
It's going to be interesting to see, Critty, whether or not. So will the earnings season, so at the moment, stocks are being, I wonder whether there's sort of horse and cart here. Is the dollar being impacted by the fact that stocks are doing well, or are stocks doing well because they're being impacted by the dollar? And you throw the earnings story on top of that, what are we going to get? The early indications out of the earnings season are good. I look at Delta today. Those numbers are sensational from Ed Bastian.
They are, and I have to say, I think right now it is the dollar is affecting the stock market rather than vice versa. It could flip, though, and that will really be a function of sentiment. I don't think we're there yet, simply because as you see kind of tick by tick, it's really a function more of yields than anything else when you look at what is actually moving the dollar. That being said, I think when you talk about the earnings story, I don't know if you've noticed this, but this is kind of a very minor piece, is that every company is now putting extra emphasis when their earnings calls and their statements about earnings X currency. So they're factoring that currency out, which is really interesting, because when they're talking about it with a currency adjusted basis, it changes exactly what they're telling you, which is simply that people have been long the dollar for a very long time. A lot of these companies as well are sitting on piles and piles, not just of cash, but of dollars specifically, which you are going to now see kind of deployed not just in the U.S., but around the world. And I think that is where the dollar stock story kind of correlates.
Well, Liz, and this is a great way to kind of end in terms of then the repercussions of that. If the dollar continues lower, where are the biggest shakeouts within across assets?
Well, I think the dollar continuing lower, like Critty says, is good for the big multinationals, because their earnings, when they bring them back from abroad, are stronger. I think it's a bit circular with rates, because the dollar is weakening a lot because of rates. And we've got some folks saying the 2-year yield's going below 4% by the end of the year. That's a pretty big move, right? So I think that circular trend is going to keep going, that weaker dollar. I mean, like Critty's talking about the way they give the earnings. I've done a few stories through the years about, how they get hurt when the dollar moves a lot and they're not hedged. So, I mean, it goes both ways for these companies, right? They got hurt a lot when the dollar strengthened. Now, like Critty's saying, there's some chance that some of them get hurt on the way down, but, we'll see how it all shakes out.
Great conversation, guys. Really appreciate it. Critty Gupta and Liz McCormick, thank you both very much. All right, coming up, it is Marna question of the day. Where does the buck stop? Matthew Rowe is head of cross-asset strategies over at Nomura Private Capital. He's joining us next. And before we head to break, Senator Elizabeth Warren was on Bloomberg Television yesterday and had this not shocking message for Fed Chair Jay Powell.
We have great news today that inflation has been cut by 2/3. So my message is take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
earnings season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think it's a bull market until proven otherwise. So if we are going to avoid that recession and the Fed really does have inflation under control, then I find it hard to argue that we're not in a bull market.
That's Callie Cox, U.S. investment analyst at eToro, talking to us yesterday, which brings us to the question of the day: where does the buck stop? Matthew Rowe is head of cross-asset strategies over at Nomura Private Capital, is with us. Where does the buck stop?
Well, I think, time will tell, of course, but what's driving it right now is that I think a lot of investors feel like we've effectively reached cruise altitude, right, to use airplane terminology, where a lot of the long dollar trade was chasing the benefit connected to rising interest rates in the U.S. And now I think the broad takeaway from my perspective is that investors feel like we can see the terminal rate. It's somewhere in the near future, and it's time to take that trade-off. And I think that's a big driver.
What does Matt, good morning. What does the dollar going down signal? If you are looking to invest money, what signal should I take away from that weaker dollar?
Well, I think that, your earlier spot with Critty brought up a good point that the multinationals will benefit from that as they repatriate or bring those earnings home. But it signals potentially a global investor view that there's a diminishing of the U.S. exceptionalism, which is to say that if we are going into a different era, maybe people feel better about being diversified globally from a currency perspective.
If that was the case, why would U.S. equities then be rallying?
Well, that's a great question. Personally, I think it's because there's not much breadth in the U.S. equity market. So if you look at the S&P, for example, I believe the top 7 names represent about 25% of the index. Today, Amazon announced record Prime Day sales, and they're announcing earnings in 2 weeks. And we have a situation there where there's a tremendous amount of calls being bought on Amazon this morning, betting on earnings outperforming, and that represents a significant portion of the index. So if you look at implied correlation, it's historically, from a historical perspective, it's extremely low, which leads me to believe that, a lot of companies are failing or underperforming, but the heavyweights are doing well.
So what do you do right now with that? How do you play that? Do you sell U.S. tech and buy European defense? What's the trade-off this?
Well, I think, even looking at the news flow today, you can kind of see the themes that I'm following, which is that I think the equity story is getting a little bit, back to the airplane analogy, getting a little bit of altitude sickness from my perspective. The valuations look a little bit stretched, and they are based on themes that I think are hard to get behind at the moment. And further to that, I think that there are obvious opportunities in credit, particularly in the private credit market, where you can see low double digits to mid-teen returns as a senior secured investor if you're putting money to work now that are very attractive. So when you look at the risk profile of, say, the equity market broadly and the opportunities in, say, the private credit space, there's a big difference there.
Yeah, that also echoes, Guy, what we hear a lot in the debt space, and also PIMCO yesterday talking about how they're definitely going to go heavy into the space. Maybe now is not the moment, but that they're really looking for that distress. The question then becomes sort of that capital hasn't been tested in any kind of real downturn yet, so how you manage that.
Yeah, I think understanding what the risk profile in the credit market is going to be is difficult right now. We talk to a lot of people in the credit markets. They're talking about it being a real sweet spot. They're saying that actually valuations look really good right now. Yeah. But there are a lot of ifs and buts. Yeah. Matt, does this apply to all of credit? Does it apply to public credit as well? Yeah. Do you just want to avoid equity and focus instead on fixed income, be it bonds, be it public credit, be it private credit? Yeah, I don't think you should ignore equity entirely, but I do think that with interest rates as high as they are and spreads where they are in carry terms, that there's an incentive to be underinvested or underexposed to
to equities at the moment. And I think it's really important to point out that vintage matters in credit, right? If you have a pool of private credit investments that were, say, originated 4 years ago, the covenants are probably a little bit light. The attachment to collateral is probably somewhat vague or not as tight as you'd like it to be. Fast forward to today, it's an entirely different world. So if you're putting money into private credit now, the terms are better for the lender. They're more onerous for the borrower. The conditions are broadly tighter in terms of the legal attachment. And the valuations are lower. So I think, you just have to be careful, Guy, to your question. I think you need to be careful. There's reasons to be concerned about commercial real estate.
Sure.
And I think there are reasons to be bullish on residential. And there are, even below that, there are more undercurrents. So I think if you're putting money to work now, it's very different than if you have a current book of risk in the private credit market that's, say, 5 years old.
Right. Okay. Fair point. All right, Matthew, thank you very much. We appreciate you. Matthew Rowe, head of cross-asset strategies over at Nomura Private Capital. So Guy just got a lot of airline stuff, so now I get to have some oil green stuff. Exxon is agreeing to buy Denbury for $4.9 billion. It is the oil giant's biggest acquisition in 6 years. Now, the deal is going to provide Exxon with the largest network of carbon dioxide pipelines in the U.S. So joining us now with more from Texas is the man who put together the deal. Dan Ammann is president of Low Carbon Solutions at ExxonMobil. Dan, good to see you. Congrats on the deal. This is truly a way to play the IRA subsidies, right? You're going to be able to move carbon dioxide very efficiently, and you're going to be able to put it in the ground and get a nice subsidy from the government. Why did you buy that instead of build it yourself?
Well, just to zoom out a little bit, Alex, 80% of the world's emissions come from some combination of heavy industry, power generation, and commercial transportation. And one of the most important tools that we have in the toolbox for addressing those emissions and reducing those emissions is carbon capture and storage, where we capture carbon dioxide emissions before they go into the atmosphere. We transport them through a pipeline, and then we store them securely in geologic storage deep underground. And over the last year, as you and I have talked about before, we've made significant progress, not just on ExxonMobil's own operations, but helping third-party customers in the steel industry, industrial gases, ammonia production, decarbonize their operations. And what this acquisition of Denbury does, as you said, is brings a significant CO2 pipeline network to us, will enable us to reach an even broader set of industrial customers and to help them decarbonize their operations and really accelerate our efforts in this space really significantly.
Yeah, and you've made a few agreements like Nucor, Linde, CF Industries, so it's also about, like you mentioned, hard to decarbonize industries. So it brings me back to the question, though, why did you buy it and not build it? I'm just trying to get to the economics of it, and then when does it become profitable?
Yeah, so this is all about accelerating our efforts that are underway, and so if we're able to acquire a really significant piece of existing infrastructure, that's going to allow us to move much more quickly than if we were to go out and to try to build and replicate that infrastructure ourselves. There are pipeline systems that we are building to support the existing projects that we've already announced. But what this is really going to allow us to do is to accelerate the growth of this business and do that on a very profitable basis. And what's important about having a business that is both growing and profitable here is that's what's going to be necessary to attract the capital to scale up and to have the really significant impact on emissions reductions that we all are aiming to have here.
Dan, good morning. It's Guy. Can I just ask you a quick question about where the CO2 that goes into the pipelines ultimately ends up? Does it end up in storage, or, as Denbury originally used it for, is it used for further extraction of oil from wells that are struggling and are coming to the end of their life cycle? What does the CO2? Where does the CO2 go?
So today, for the existing projects that we at ExxonMobil have already announced that Alex referred to a minute ago, that CO2 is going into permanent geologic storage. Denbury's business was originally built around what we call enhanced oil recovery, which you were referring to, which is helping increase production from mature oil and gas fields. And that's an interim approach that that can be used, but our goal in the medium to longer term is to really focus on the secure permanent geologic storage that's not associated with enhanced oil recovery.
Okay. What's the catalyst for this deal? The President's Inflation Reduction Act.
Yeah, Inflation Reduction Act is providing an important catalyst role, not just for this deal, but for the early stages of the development and growth of this industry. At the same time, while this policy and constructive policy is important to get things going, it's our responsibility as industry to build a business that can get the cost of abatement down, cost of carbon reduction down, to the point where the market can pick this up in the long term. In the long run, we need a market-driven carbon reduction industry and business to evolve here. But it's the IRA and other policy like that is important to get that flywheel going, to get us onto the cost curve and to start to make progress towards that.
Dan, Exxon has pledged about $17 billion on these kind of low carbon investments through 2027. So now this is a good chunk of that. Can you confirm for me that lithium will be the next one?
We see an interesting opportunity in multiple different low carbon value chains, and that's something that that we could take a look at.
Well, you've been buying up acreage in Arkansas, right? I mean, is that for this reason? And if so, where do you think your expertise lies in dealing with lithium?
Well, if you zoom out and look at lithium production, one of the approaches to produce lithium is from deep brines, that are associated with production from deep underground aquifers. And so there are capabilities that the oil and gas industry has around that that could be applied to that.
Dan, I got two stories on my screen in front of me today relating to the energy industry. Exxon doubling down on carbon capture strategy with Danbury deal, and Shell looking to explore selling stakes in its renewable power units. Dan, the lesson that European majors have learned is that they get a lower valuation if they pursue energy transition, and they are now fighting back against that and potentially going to be shedding assets. What lesson have you guys learned at Exxon from that journey that the European majors and their valuations have been on?
Well, I think the lesson is pretty clear, which is that you need to have an advantaged position and bring an advantaged set of capabilities to whatever it is that you're pursuing. And so when you look at the low carbon value chains that we're pursuing, both in carbon dioxide, in hydrogen production and ammonia, those are all leveraging really significantly the capabilities that exist inside of ExxonMobil today.
Yep.
And so we're very focused on taking things that we know how to do, advantages that we have, and bringing those to bear in the low carbon space. And that's a different strategy than some others have followed.
Which, Dan, I think that's why the lithium thing, I think, confuses me. It seemed like Darren Woods was confirming that Exxon was going to be in lithium in an earlier interview. And it's hard for me to then understand the synergies there, and if we're going to see big oil here kind of move into the same trap that big oil in Europe has fallen into.
Well, the synergies are, as I said, if you're extracting resources from deep underground, that's something that we know how to do. If you're producing large quantities of water from deep underground, that's something that we know how to do. And if you're processing that to extract minerals or other materials from that, that's something that we know how to do. Yeah. And so you're tapping into the subsurface expertise and know-how that we have that underpins the oil and gas business that we've been in for a very long time.
And Dan, you think those industries, what you're talking about there, will command the same kind of valuation multiples as what you do now, i.e. producing oil?
Yeah, I mean, we're very focused on building a business that is profitable, that has strong returns in this space, and I think that is also central to what we're trying to do here. And the reason that's important is we need to attract the capital necessary to scale this up, to help accelerate the world's path to net zero. And if the business isn't generating the right kind of returns, you're not going to attract the capital that you need to do that. So it's sort of business basics. If we build a great business, it'll attract good returns and will attract the right valuation over time.
Hey, Dan, really great to chat with you. Look forward to the next one. We'll catch you soon. Dan Ammon joining us, President of Low Carbon Solutions over at Exxon. And Guy, what's interesting too is there were lots of rumors in the market that Exxon could buy Pioneer, and that would be a pure levered up shale play, levered up in terms of increasing oil production. And I wonder if this kind of takes it off the table a little bit and gives some breathing room, or if it's still kind of on the table.
Yeah, well, maybe the IRA has changed the narrative around that. But I still come back to this issue that it's fascinating that European majors have struggled to make this work on valuation basis.
Yeah. Anyway, that's more coming up. You got big banks reporting tomorrow. We'll get Betsy Graysick from Morgan Stanley. This is Bloomberg.
authority.
We're about an hour into the U.S. trading session that's still developing as by everything except for the dollar. Abigail, do a little tracking that move for us. Abigail?
And that will be our theme here, Alex. So let's start off with what is working, which is pretty much everything. To your point, take a look at the S&P 500 up a fourth day in a row. The NASDAQ 100 even higher than the S&P 500, also up for 4 days in a row. Big tech really joining in. A couple days ago, we had some wobbles with big tech, but right now, take a look at Alphabet up 3.4%. I'm not exactly sure what's behind this. It could be a catch-up trade, up only 38% this year, but when you put that to Meta's 160%, investors might be looking for the big tech that has not performed as much this year. Amazon, a record Prime sales day, so the U.S. consumer, worldwide consumer, seems to be alive and well. To the point of Alex and Guy and the theme on the day, and we'll be getting there in just one moment, but let's lead into it. Yields, take a look at this. Over the last 5 days, this 2-year yield down 32 basis points at a 4.66. Again, last week or the week before when it was above 5, I really did think it looked pretty comfortable there, but clearly not. It's back right down, come right down. The 10-year yield also down. What's interesting about this, Haven bonds are rallying, so we're so trained right now to be thinking about it just in terms of yield stocks, the inverse relationship. But this is something to think about. We do have yields rallying. What we don't have rallying is, of course, the Bloomberg Dollar Index down 5 days in a row, down 2.5% over that time period. The worst stretch of the year. This is the story of the year, though. If we go into the Bloomberg terminal, this is super interesting. This is a piece of yesterday's chart together with the S&P 500, and we can see that the Bloomberg Dollar Index in blue, this is basically this year, down, down, down. The S&P 500 up, up, up. This is the real inverse relationship because, of course, we've had yields all over the map, but stocks steadily higher. What I want to point out again, though, the Bloomberg Dollar Index, that RSI, is now officially oversold. The other times that it's gotten even close to oversold, we've seen a pretty decent rally for the Bloomberg Dollar Index. So, Guy, if this chart holds, it suggests we will see a bounce in the Bloomberg Dollar Index, and that could mean that we see a little bit of a pullback, at least in stocks.
It's going to be fascinating because we're going into earnings season as well, Abigail, and that's just